Hi, Mr. Mortgage back at you with a condensed version of my 9-minute Lehman story. I just want to go over the facts here and leave all the other out. What we're going to do is we're going to look at the Lehman Brothers correspondent or conduit lending division program guidelines. When I showed you last time, I said these are the loans they did. These aren't actual loans. This is a matrix of the kinds of loans they did, the Alt-A loans and the lending guidelines. Lehman was the father of the mortgage industry and the exotic industry. Back when the exotic loans first started coming out in mass back in 02, 03, Aurora Loan Services really came into its own. They didn't lend to the public, retail. They lent through mortgage brokers or through other mortgage bankers who would basically rebrand these programs and put them out and sell them through their armies of loan officers around the country. Same with Bear Stearns. But Lehman was a much larger player in the mortgage industry. As a matter of fact, they say all roads lead to Lehman in the mortgage industry, and we have for years, and that's absolutely true. Now that Bear's gone, of course, Lehman is at the top of the hype pile, which is why I kind of wanted to focus on them, especially since they reported such wonderful earnings, took very little write-downs. As a matter of fact, if you go to portfolio.com, there's a story by Brad Hintz called The Debt Shuffle that outlines and breaks down their earnings. It's a wonderful story. You just have to go read it. So what I'm going to do here, instead of talking so much like last time, I'm going to actually show you what kind of loans they did, and it'll come in a little bit clearer because I'll get it a little bit closer up to the screen. This is Aurora Loan Services Conduit Lending Division. First, full doc and alt doc. That means either tax returns or substitution of tax returns. They did 100% loans, the LTV, CLTV. So LTV is 80 or 90, of course. CLTV up to 100% for purchase, rate term, cash out. 1 to 4 units, down as low as 620 and 660 or 680 scores. Then we go into stated income, no ratio. That means you know, liar loans basically. Here we are again. $1 million, 8,100. There's no cash out allowed on that. See that? But 1 to 2 units, and here's your scores. If you're at 100%, you do need a 700 score on that one, which isn't too real bad. 680 on that. But this is one of their tighter programs. They do allow DTIs up to 50%. Now keep in mind, a debt to income ratio is just what it sounds like. If you have $10,000 worth of income and $5,000 in debt reported on your credit report, that's a DTI. They'll let you do that. What about taxes? What about insurance? What about food and savings? You know, the people at 50% DTI, that means 50% of their gross income is going to debt. And actually, there's a program here that allows 55 DTI. Here we go with no doc. This is actually no documentation whatsoever. It's purely based on a credit score and an appraisal. 90% loans with 680 credit scores to 650, 500, $1.5 million. Now let's get down here to their hybrids and their interest onlys and programs like this. Here we are back here again, $1 million, 100%. Right here, there's a non-owner occupied program actually, 500,000, 100%. That $1 million program only required you to have a 680 credit score. And we've learned a lot about credit scores lately. They're not a good predictor of ability to repay in the future because people could buy themselves a credit score. For example, you start off 5 years ago with a 600 or a 580 credit score because you've never been able to pay your bills all your life. You buy a home using a subprime loan through Option 1 or New Century or Lehman or Bear. You pay that loan on time and your credit score goes up, but your house is appreciating like crazy. As you're going broke and as you're spending all your money and not able to pay your bills, you go stick a home equity line on it, or you do a cash out refi, pay all your bills, and that improves your credit score. So essentially, people could buy their way into a good credit score over the years. So there's a lot of people out there sitting with 700, 720 credit scores without a lot of depth of credit that never should be there. They just bought themselves a credit score because of the massive appreciation of their homes. And subsequently, they pulled all their cash out. As a matter of fact, if you look at all the subprime loans in existence over the past 4 years, 3 or 4 years, over 50% of them are cash out refis, which means we're bailing out subprime loans where the people pulled the cash out. They're not purchase money loans, they're cash out loans. So we're bailing out refis. Same goes for Alt-A loans. Out of loans in existence out there, most of them are cash out refinances. So people cashed out, then they got in trouble, now the government's bailing them out. It's pretty incredible. Okay, let's go down to a different program here. Their 5-year fixed neg-am program. This is a neg-am, a negative amortizing loan. It's a 5-year fixed. Again, $1 million, 95% down to a 620 credit score. Stated no doc for that program. $1 million, 90 and 95, 680 credit score. And of course the good old no doc, $1 million, 90%, 680 credit score. Mortgage maker, high LTV first liens is next. Full doc programs, $1 million, actually up to $4 million with a 600 credit score. $1 million, 100%, 680 credit score. Stated no doc, $1 million, 100%, 50 DTI, and a 660 credit score. And of course, as the loan amount gets smaller, it's more flexible, lower credit scores and whatnot. Stated income, stated assets, $1 million, 620 credit score, 50 DTI, and no doc, of course, 95 to 650, 620 credit score. These are more. Next one is mortgage maker first liens. These are one loan, but of course they're insured through your mortgage insurers, and you notice the name, Radian, PMI, MGIC, and so forth. So if you wanted to know what the mortgage insurers are insuring, that's the kind of loans they're insuring. That's a whole different topic. We'll do one on mortgage insurers later. Now let's take a look at what they considered, the different doc types. Of course, stated doc, all lenders considered stated doc to be what it says here. Verification of income not required, no 4506 required. Ratios are calculated based upon the stated income, yada yada. That is typical in the industry for the last several years for stated income. However, this no ratio program here, where you provide a job, but you provide no income whatsoever on the credit report, what they say here is kind of startling. Income amount should not be disclosed, that's fine. Income amount is not verified, that's normal. But this, income source, that means the type of job must be one which reasonably supports the ability to repay the mortgage debt. Reasonably supports the ability to repay the mortgage debt. That's incredible. That means they're saying, when you stick a job down there, you don't have to put any income in there, but just make it sound pretty good. You got to make sure it reasonably supports. Therefore, a landscaper shouldn't make more than $8 grand a month. But since you don't have to put income down there, just make sure he doesn't buy a house worth more than $1 million. And that's about it. That is the short version of the Lehman guidelines. Keep in mind, these are not loans. These is just the loan programs and what they did. 90% of Lehman's loan volume out there is likely this kind of business. And these loans are still sitting on their books. We don't know what they have. They haven't told us. They've wrote them down 3% or so. So that's for you to make the decision, are this kind of loan in the bubble states like California, is this going to cause more problem for Lehman in the future? Everyone seems to think now it's all better, and it won't. I don't agree with that opinion. Anyway, have a great day, and don't believe the hype. Also, I always take you on at the end to go to www.foreclosureradar.com. It's a free service. Well, it's not a free service, but there's a free California foreclosure report that comes out every 30 days. And this will keep you abreast on what's happening in the California market, whether you should go in and buy or not. For instance, right now, notices of default, which are loans that are 90 days late where the lender files a notice of default, are higher than all the foreclosures and all the bank-owned properties together, meaning the real foreclosure wave hasn't even hit California yet. It's coming now. So you need to be aware of these things. You can get this free report. That's why I always refer you there. And their data is the best, the freshest, and most current around. I subscribe to the service just so I can get real-time, as close to real-time as possible, data on foreclosures in every single county and everything going on in California. I think it's wonderful. But be sure to sign up for the free service. And I've mentioned it before. I don't think I've said it was free. That's the key. All right. Have a great day. Bye-bye.